Good afternoon, everybody, and a very warm welcome to our Owen Mitchell Budget 2024 analysis. There is lots to analyse, so we've got lots to get our teeth into, which is good news. Sometimes these things come a little bit like a damp squib, but this time there's lots of meat, at least for us techie people, and I hope we can bring it all alive and make it all make sense for you. So a very warm welcome. Thank you very much for joining us. Just to run through a few housekeeping points. If you do have any questions, do please put them in the Q&A box. We'd be pleased to try and pick those up later. As it says on the screen, if you are able to submit your name and email address, then if we're not able to come back actually within the time allowed, we might come back after the event and we can respond to you later. Just to reassure you that a recording of the webinar and a copy of all the slides will be sent out to you afterwards. So that will be coming very shortly after we finish. And we will also do a feedback link towards the end, which it's always nice to get your feedback. So we do read and take note of what you say and try and learn from things that we can do better. So let us have a look at our agenda. This is what we're going to try and cover. I'll introduce you in a moment to our speakers, three of my colleagues who are able to join us. But we're going to start with a little bit from me about the context, the fact that we are in the run-up to an election and the whole stealth tax situation as the context for this particular budget. Then my colleague Jess Fazzoni will be dealing with resident non-doms, the big changes that have been announced on the IHT and the foreign income and gains side. If you like your acronyms, we've got loads of them for you here. So, get used to your FIGs and your FHLs and everything else because there's loads to come. But here we are, some really important changes on that resident non-doms, which we will be getting our teeth into. Firstly with Jess, and then secondly with Nikki Midgley from our compliance team, who will be dealing with the tax reporting side of some of those issues, and then the furnished holiday lets. We'll then talk a bit about the reduction in CGT, a bit about some of the IHT issues, and finish with a quick mention of child benefits. So that's our agenda. Let me just show you my fellow presenters. For those of you who don't know me, I'm John Bunker, a consultant, solicitor and chartered tax advisor with the firm. And it's my pleasure to host these tax webinars with you. Secondly, we have Jess Fazzoni. Jessica is in our London International and High Net Worth team, and she's one of our associate solicitors there. Then Charlotte Pritchard, who is one of our senior associates in Manchester in the Lifestyle and Estate Planning team. And then Nikki Midgley, one of our chartered tax advisors. As a CTA myself, I'm proud we've got about 10 of us across the firm, but Nikki's the one who's in our tax and trust compliance team in Chichester, who deals with, among other things, some of the non-dom tax compliance stuff. So as an associate CTA, she's in a good position to comment on some of that stuff. Just to show you where we are, we have a little map for you, which will show you the spread of our offices across the country, and I hope that you have some experience of dealing with at least one of those. There it is for you, including our expansion into Scotland, a bit more of Scotland. And that done, let's go straight into our first subject, pre-election and stealth tax context. And what I'd like to do is to really just remind ourselves where we are. There is going to be an election. We know now from the Prime Minister it's not going to be on the 2nd of May with the local elections, but there will be an election later this year, and this may be the last fiscal event. We are used to now to talking about that terminology. There could be a second fiscal event in the autumn, shortly before an election, say in September, October. So the point of this is that all of this needs to be enacted before that. And we're used to our normal timetable that we get enacted by July, royal assent by before Parliament recesses at the end of July. Some of the announcements, and we will flag this up as we go through, but some of the announcements do need consultation. And those that need consultation will need to be consulted on and then enacted before an election. So that's a tall order in some cases. With the case of resident non-doms, that's going to be really quite difficult because the legislation is really complex, and we'll see in a moment some of the issues there. It might be easier with the new £5,000 British ISAs. The consultation is needed there, and it'll be easier to introduce. So that's pretty likely to come in. But you take my point that actually, there's a timetable here which is going to be quite tight. And some of it may not get through. So some of what we are talking about may end up being election commitments if there is no time to actually enact it before the relevant election date. Just to say, tax admin and maintenance day, which is on 18th of April, is often a very boring thing, but on this occasion, the details of that could be more important. There could be a lot more substance, so keep a watch out for that. Okay, and then to say, going on to 1.2, what would happen if, and one of the questions somebody had asked in advance was, what might be the position with a change of government? Labour have said they will keep many of the tax changes, including the latest national insurance cuts, the extra 2 pence off the NICs, and that it is part of of where they are as a party. The details may be changed. So from resident non-doms, where the Conservatives have taken on their policy, the detail may be a little different, but essentially we are looking at a lot of the tax changes still being the same, with Labour giving themselves very limited room for manoeuvre. Going on to the NICs, the changes which we've put on slide 1.3 are the 2% cuts. I've given you the dates there, the difference between the class 1 and the class 4 in terms of when they're coming in. The big point about that is all of that is offset for so many by the fiscal drag with income tax and CGT. So, that takes a lot of people into higher tax rates. And then on my slide 1.4, I just finish off this little introduction by saying that for some people, this income tax freezing is particularly significant. The NICs are definitely a change of burden of tax. They are focused more towards the working population, so it's not going to help the retired, it's not going to help those with savings and investment income. But what we can do, what you can do, and we can help you with, is the planning for many of your clients, because for many people who are looking at investment and savings income, we can review that now. There's a time to take stock of the tax effectiveness and consider, while, as I say at the bottom in red, the employees may not have the flexibility to do that. For others, there may be a scope to change savings, and particularly my last line, particularly, for example, spouses, to avoid unnecessary increased tax rates. Can spouses transfer between them, do some transfers to kind of get the assets and the income and gains in the right hands. Okay, well, that is just a little introduction. Let's now go to Jessica Fazzoni, who's going to speak about resident non-doms. As I say, Jess is part of our London International and High Net Worth team. So Jess, over to you for the big subject.
Thank you, John. Okay, I want to give you all a heads up on sort of the order of the coming slides. So I'm going to start off by covering inheritance tax for individuals. I'll then move on to inheritance tax for trusts, before then coming on to income tax and capital gains tax, first for individuals and then for trusts. So starting with inheritance tax for individuals, from 6th of April 2025, we are going to be moving to a residence-based system from a domicile-based system. So currently, a non-UK domiciled individual is not subject to UKIHT on their worldwide assets until they have been UK resident for 15 out of the last 20 years. So a non-UK domiciled individual will only be subject to UKIHT on assets situated in the UK. With the residence-based system from 6th of April 2025, if you've been UK resident for 10 years, you will now become subject to UKIHT on your worldwide assets. This is of particular relevance to individuals who have already been in the UK for 10 years or will have been UK resident for 10 years by April 2025. They will immediately be subject to UKIHT on their worldwide assets and will need to effectively accelerate any planning that can be undertaken before then. Under the current rules, they would have had an additional 5 years to plan for this, but because they would only have become subject to UK IHT on worldwide assets once they'd hit that 15 years. So this is something really to bear in mind now, that those individuals will now only have 1 year of planning before 6th of April 2025. Now, I'm just going to repeat what John said. It's really important to say that this is all subject to consultation. So, but individuals that will be affected need to think now about planning, especially if they plan to remain in the UK. So it's a question of looking at what assets you own personally, what's the value, what will your IHT exposure be at April 2025 if you do nothing, and perhaps considering putting trusts in place, which I will come on to. And even at sort of the most simple of planning, which is reviewing UK wills, make sure that they are well structured and tax efficient, and you've got tax efficient wills in place. For individuals who are planning to leave, they should be aware that under the new proposed residence-based system, they will be subject to a 10-year tail. At the moment, the tail is 3 years, so this is something that might require some careful planning and consideration. So leavers, individuals planning to leave, also need to be careful about any planning that they do whilst outside the UK, but within this tail. Again, all sorts subject to consultation, but it's clear that some planning will need to be undertaken. And to start with, non-UK domiciled individuals need to understand how these rules will impact them and what their worldwide exposure will be from April 2025. So moving on to trusts. If a non-UK domiciled individual settles non-UK assets in a trust, then those assets are excluded property and fall outside of the UK IHT net. This IHT treatment will continue for trusts created prior to 6th of April 2025. So this is another planning opportunity for you or your clients to consider, which is whether you should set up an excluded property trust to protect their non-UK assets from UK inheritance tax. However, whilst it's beneficial from an IHT perspective, we need to just be careful about the capital gains tax and income tax exposure, which I will come on to a bit later. But from an IHT perspective, you have until April 2025 to settle non-UK assets in trust to benefit from this IHT treatment. Then we have new trusts and additions made to existing trusts after the 6th of April 2025. Those will be subject to a new residence-based system. Again, as I said earlier, the rules are subject to consultation, but the main point to note is the set laws residents, so the individual putting assets into trust, will be assessed not only when the trust is set up, but also when relevant property charges arise. For example, when the trust is assessed to inheritance tax on its 10-year anniversary, or when assets are appointed out of the trust to beneficiaries and subject to IHT exit charges. This will also be relevant to individuals who have left the UK but are still within the 10-year tail. So the key takeaway is for individuals to consider settling non-UK assets pre-6th of April 2025, but perhaps to wait for the consultation and actual legislation before implementing anything at this stage. And then moving on to income tax and capital gains tax for individuals. So again, at the moment, we have the remittance basis of taxation. It allows non-UK domiciled individuals to elect to be taxed under the remittance basis, which effectively means that they do not pay UK tax on foreign income and gains, so long as they do not bring those foreign income and gains into the UK. If they do, then they're subject to UK tax on those remitted funds. The remittance basis is free to claim for the first 7 years of UK residence, and then there's a charge of 30,000 going up to 60,000 once you've been here 12 years. So this regime is being abolished and replaced by a 4-year foreign income and gains regime. So this is the FIG regime for short, which I quite like the name. To qualify for the FIG regime, you have to have been non-UK tax resident for 10 years. So for individuals who have already been UK tax resident for over 10 years, or 10 years by the 6th of April 2025, they will not be able to benefit under the FIG regime. It's worth noting here that residents will be assessed under the statutory residence test, and treaty residents and split year treatment will be ignored. So if an individual qualifies for split year treatment, so they're treated as tax resident at a later point in the tax year, or if they're treaty tied to another country, that's ignored, and they're simply treated as being UK tax resident for that year for the purposes of qualifying for the FIG regime. So the FIG regime will apply for 4 UK tax years only. Under the FIG regime, you pay no UK tax on any foreign income and gains arising to you in those first 4 years of UK residence. There will be no UK tax whether you remit the foreign income and gains or not. After the 4 years, you're subject to UK tax on your worldwide income and gains. Like the remittance basis, you're going to have to elect into the FIG regime, and if you do elect into the FIG regime, you lose your personal allowance and capital gains annual exemptions. The FIG regime is more generous than the remittance basis. At the moment, the remittance basis requires significant planning with segregation of accounts, creation of clean capital. Before you become UK tax resident, you can't remit any income and gains arising without paying UK tax. Whereas the FIG regime is meant to be simpler. Individuals looking to move to the UK will find that this regime is actually more tax advantageous, as you know, there'll be no UK tax on their foreign income and gains in those first 4 years of UK residence. There will still be planning around segregation of income and gains pre-arrival, but this, you know, will be simpler. And my colleague Nikki is going to talk about sort of mixed fund rules a bit later on, and some more planning points on that. 4 years. It may work for some individuals wanting to move to the UK. Perhaps they have children going off to university, but it's not long enough perhaps for a career move or for children going through you know, school. So planning needs to be undertaken for even those clients who are thinking to take advantage of the FIG regime. You know, you need to be aware that after those 4 years, you'll be subject to UK tax on all your foreign income and gains. So there will be some transitional arrangements for existing sort of non-DOMs who will, from the 6th of April 2025, move from the remittance basis to the arising basis and who can't benefit from this FIG regime. The tax reliefs are on the slide on screen. So you will see that you will have the option to rebase assets personally held to the 5th of April 2019. There will be a 50% exemption for the taxation of foreign income, which arises in the year 2025-26. But the key point to note is the 50% exemption here is on income only, not capital gains. So we have to be careful there. There will also be a temporary repatriation facility. So for 2 years, individuals can bring their pre-2025 foreign income and gains into the UK at a flat rate of 12%. So this is quite generous and allows for some significant planning here. So in terms of the planning opportunities, some of these points will also be covered by my colleague Nikki from a tax compliance perspective, but I'm going to just mention some key points. So you and your clients may consider, for example, perhaps selling an asset at a gain pre-6th of April 2025. So you've got this up and coming tax year to do that. The capital gain is then subject to the remittance basis. So your client needs to claim the remittance basis. And then they can bring that gain to the UK at 12% within those 2 tax years. If they remit the gain post April 2027, okay, so after that sort of 2-year period, or the gain arises post 2027, then the gain will be taxed at 20%. So there is a tax saving here if you plan early. So just to reiterate that if you sell an asset post 6th of April 2025, then the gain is subject to 20%, because as I mentioned earlier, the 50% exemption only applies to income for that one tax year, 2025-26, and not for capital gains. So careful planning here for the coming year. You may also want to consider managing when income and gains arise. So I think most of the planning is going to go around taking advantage of the transitional reliefs. and then post 6th April 2025, managing the income and gains position. So, for example, clients might want to consider something like an offshore bond or something that allows them to control when their gains will arise. I think the key thing to say really is start taking advice. It may be too early to implement anything just yet, but we really want to see the detail here first. What after the consultation, we need to see the legislation, but I think, you and clients need to start thinking about what might be possible to achieve, and also at short notice. So then moving on to trusts. Broadly, the current position is that foreign income and gains can roll up UK tax-free in a trust settled by a non-UK domiciled individual if certain conditions are met. UK tax resident beneficiaries are then sort of subject to UK tax when distributions are made to them. So you can effectively control the sort of UK tax position. However, from the 6th of April 2025, settlor interested trusts will no longer have this protection from tax on foreign income and gains. So if you have a settlor interested trust, the income and gains of the trust will be taxed on the settlor. If the settlor and the beneficiaries qualify for the FIG regime, then benefits that they take from the trust or distributions that are made can be made to them free from UK tax. But any pre-6th of April 2025 foreign income and gains will continue to be matched to distributions sort of as they are now. So in terms of what you and your clients should be doing, you should start reviewing existing trusts and confirm whether they are settlor interested. So we're looking here at whether the settlor is beneficiary, but also whether there's minor children or grandchildren named as beneficiaries. You need to also consider how the trust assets give rise to income and capital gains and whether this can be managed within the trust. So if the trust is settlor interested, then the settlor is going to be subject to UK tax on any income and gains as they arise, unless they qualify for the FIG regime. So again, really important to consider what assets does the trust hold, and then to consider and really understand the actual income tax and capital gains tax position of the trust post April 2025. So that you can then look at what steps can or should be taken to minimise that tax exposure for the settlor. So, for example, if the trust has limited income and can control the capital gains position, a settlor may be willing to accept the income tax charge, and particularly where excluding the settlor their minor children is not possible. On the other hand, there's cases where the tax position is likely to be extremely punitive, so may want to consider excluding the settlor and minor beneficiaries from benefit to avoid those sort of settlor interested provisions. But again, this really needs careful consideration in terms of what powers the settlor retains, whether the revenue could still argue the trust is settlor interested. So that's not going to be an option that sort of will fit all scenarios, and careful planning needs to be undertaken. I want to be really clear, there's no sort of planning that's going to fit all scenarios. So it's very much sort of looking at case by case basis, looking at each client scenario, what are your motives, what are your future plans, so that you can then consider the best approach and options available, and then perhaps wait and see what the legislation says, so before implementing anything. But settlors and trustees need to be aware of how these changes will affect their tax position from 6th of April 2025. That is sort of certain. And then I'm just very lastly going to mention something really brief about the Fisher case and the transfer of asset abroad rules. So sort of very deep in the spring budget was a very brief reference to the amendment of the transfer of asset abroad rules following the sort of Fisher case. This will not affect everyone, but it's worth sort of a mention here, as it wasn't headline news. I'm sort of sneaked in the budget paper. So anyways, the transfer of asset abroad rules, they're extensive anti-avoidance provisions. They broadly seek to tax a UK tax resident individual where there has been a transfer of assets which results in income arising to a person abroad. The Fisher case is a Supreme Court decision where the taxpayer won against the revenue. And it was held that the transfer of asset abroad rules do not apply to a shareholder of a company where the transfer is made by the UK company, even if the said sort of shareholder is a director in the company and therefore took the decision to make the relevant transfer. Now we have draft legislation. The Finance Bill has been published and seeks to amend the transfer of asset abroad rules to close this loophole and effectively reverse the Supreme Court decision. So broadly, an individual participator, so this can be a sort of shareholder, I mean, the definition is a bit broader than that, in the closed company, which is by definition a company with 5 or fewer participators, so perhaps less than 5 shareholders, will be deemed to be the transferor for the purposes of these anti-avoidance rules, unless there is no tax avoidance purpose or if there's a genuine commercial transaction. So this is very much a scenario to be looked at where you or your clients are participators in a UK company or non-UK company, and the company itself makes a relevant transfer which gives rise to income to a person abroad. And just to note, person abroad could be trustees, a trust company, or another company, for example. And that sort of wraps up all my slides on the budget.
Thank you very much, Jess. That's great. And can I just highlight one particular point, Jess? There's lots of really good stuff in there, but one particular point was Jess mentioned the wills, not to overlook reviewing your wills. And Charlotte, as an estate planner, would very much want us not to lose sight of the importance of being aware of what you're doing with your wills and your estate planning when you're doing the review, because you need to really factor that into your overall strategy and make sure that is covered, so you don't inadvertently kind of leave yourself lost with the wrong will or no will in place. So let's now go on to Nikki Midgley. Nikki works in our compliance team, so based in our Chichester office, looking after the compliance for a lot of our international clients. And she's going to talk about non-doms first and then go on to the changes with regard to furnished holiday lets. Nikki, over to you. Thank you.
Thank you, John. So yes, I'm just following on from Jess's update regarding the domicile changes. So I'm going to be looking at some of the points that some clients really need to be considering. So firstly, the new FIG regime. So obviously, as Jess mentioned, this is going to apply to individuals coming to the UK from 6th April 2025, or individuals who have been UK resident for less than 4 years prior to April 2025. So tax residency will be based on the current statutory residence test, and as Jess said, so no split year treatment. So you're either going to be tax resident for the complete year or you're not. So the new FIG regime that's going to last for 4 years needs to be claimed each year, likely in a tax return. In that time, you're going to be able to remit all your foreign income gains to the UK. And as Jess touched on, current rules, you'll lose your personal allowance and annual exempt amount. That will also apply to the new FIG regime. So some consideration needs to be taken, mainly to do some calculations to determine if it's worthwhile claiming that FIG regime, depending on your overseas income and gains. So there's no guidance yet. There will be lots of questions. We don't know, would there be a requirement to disclose the overseas income, any remittances to the UK? Will HMRC be satisfied that the foreign income doesn't need to be reported in those first years? We just don't know. We are waiting for guidance. And then moving on to 3.1, we're looking at some of the changes that are really going to affect our existing non-dom clients. So these are going to affect our clients that are currently taxed on the remittance basis. They're going to be moving from being taxed on the remittance basis to a worldwide income and gain basis. So previously they would have completed their tax return to include UK sourced income only, and maybe gains of remittances of income or gains to the UK. So their tax return may have been quite straightforward. They would have had a tick on the residence pages. It could be simple, but from the 6th of April 2025, they are going to be taxed on, as I say, worldwide income and gains. So they are going to need to consider the type of overseas income, how it's treated for UK tax purposes. This is often not clear. You may have non-reporting funds, you may have excess reportable income to consider. It's not always easy to identify the type of income and how it's treated for UK purposes. It's also not easy to get the information for the return sometimes, but that can be a bit of a battle. And in addition, so you're going to be looking at double taxation treaties just to determine if foreign tax credit is allowable, if it's not allowable. You're also going to need to consider if the reporting will be available. So you're going to have some clients that maybe are relying on other jurisdictions' tax returns. For example, US tax return may need to be completed first before a UK tax return can be completed. And then as we have this problem at the moment with some clients, obviously we in the UK have a tax year end to 5th of April, and that can be quite confusing at times. There's often a mismatch in reporting just because of the different tax year ends. And then, so finally, on this point, the tax return preparation costs, they're likely to increase for these clients. So that needs to be considered. Moving on then to slide 3.2, we've got the transitional period, the transitional periods that have been announced. Just looking at some planning opportunities around that, really. I think Jess has touched on some of them already. So for these to apply, these transitional provisions, we need to have, our client needs to have claimed the remittance basis at some point in the past. And what they're getting a bit of a soft landing for the first year, so whereby they're going to have 50% reduction in foreign income and gains. Sorry, foreign income, not gains. What possibilities do we have here? What opportunities can income be realised in this time? Looking at funds whereby maybe income can be rolled out and paid in 2025-26. Maybe an individual has influence over when a foreign dividend is paid. Maybe a foreign pension, can that be taken in that year? That's all things to be considered. And obviously, moving on, there's a 2-year period to remit foreign income and gains, which arose whilst they were being taxed on a remittance basis. This is a great opportunity to remit funds to the UK. Obviously, with the current regime, if any income and gains are remitted, that's subject to tax at marginal rates. Therefore, if that period could be utilised, you're having a 12% tax charge on that previously unremitted income. So there's definitely planning opportunity there, bringing funds to the UK. So in terms of what can be done now, we have obviously got 2 further tax returns to complete, where potential remittance basis claims can be made. So utilise this time now. I think Jess has touched on this. Consider we have clients whereby they can realise gains now, not pay capital gains tax, instead claim the remittance basis, and then perhaps they can remit those funds in that transitional period. So you would really need to look at the charge that you face. Obviously, the top remittance basis charge at the moment is £60,000. You may need to do some calculations around that as to what's the better option. Also, we're going to consider if the 5th of April revaluation, is that going to be the best saving? If possible, can assets be realised now? And as I said before, brought in at a later stage? It really depends on the assets value at that time. And so, and a final point, I think it's definitely important, as we would advise anybody coming to the UK, really have that account segregation in place, certainly for pre and post April 2025 income. I think that's going to be really, really important. And then lastly, on this segment, we've got some rules for mixed funds. So basically, HMRC the government have announced there will be changes to the mixed fund rules, but we don't know what they are yet. But basically, after that 2-year transitional period, the usual rules are going to apply for remittances of pre-2025 income and gains. So that's going to suffer the marginal tax rates. Obviously, income remittances up to 45%, gains currently up to 28%, but whether that could change, whether CDT could be increased or not, we don't know. So just touching on the mixed funds, so obviously lots of clients will have mixed funds overseas, and so basically a mixed fund, it's an overseas fund with money comprising more than one type of income gain or clean capital, or either an account with a mixture of funds over more than one tax year. And so under the current rules, there's a special statutory ordering rule used to determine which is deemed to be, which part of that pot is deemed to be remitted and subject to UK tax first. And the rules can often be complex. It can be quite a difficult exercise to establish actually what's in an account. So just very, very broadly, the income is deemed to be remitted first, then gains, then clean capital. And it's also looked at on a tax year by tax year basis. And generally, the income and gains which have been taxed overseas, they will be deemed to be following after untaxed income and gains. So it's almost a worst case scenario basis for clients. And as I touched on, the government, they have announced proposals to relax those mixed fund ordering rules in order to remit funds to the UK. But what we're not sure at the moment is whether that applies to just those transitional periods, that 2-year period, or whether that will apply to all mixed funds. We're not sure. We're just waiting for further guidance. And then moving on, completely different subject. Obviously, we've got quite a big change here. We've got changes to furnished holiday lets. So that's slide 3.4. This hasn't been included in the draft finance bill. It's expected to be included at a later stage, but it is due to take effect from 6th April 2025. So the purpose of the measure, so it's basically moving furnished holiday lets in line with long-term letting. And so furnished holiday lets, they have a huge number of benefits, which I'll talk about in a minute. So I just wanted to give some background as to what would actually qualify as a furnished holiday let. So basically the property must be in the UK or the EEA, it must be furnished, and it must be available for letting for 210 days a year and actually let for 105 days. And it wouldn't usually include lettings for more than 31 days. They're often discounted unless there's a special reason. So there's also, if that day count isn't let, and there was an intention to let the property, an election can actually be made, and it's called a period of grace election. And that effectively means that you only have to meet the criteria that 105 days over 210 days for 1 out of every 3 years, provided the intention was there. And then just looking at the benefits of the FHLs. So basically the profits are treated as earned income for the purposes of pension contributions. So this is really useful where an individual has limited other earnings. Maybe they've only got investment income, so they can still make pension contributions because the FHL income is treated as earned income. We can also claim capital allowances, which obviously reduce the overall profit subject to tax. And one of the huge benefits, obviously there's been some changes around mortgage interest restrictions. Those changes, they came in April 2017. And so they apply for longer term letting, whereby the mortgage interest relief is restricted. And so obviously only having basic rate tax available on any mortgage interest payments. So this affects higher rate taxpayers, additional rate taxpayers, because they're only getting the relief on that mortgage at 20%. Another benefit is where the FHL is owned between spouses, so the profits can actually be split in unequal proportions. This doesn't apply to obviously a normal letting, only the FHLs, but basically you could have a husband and wife, and you can allocate the income between them as they see fair. So one could be taxed on 80% of the income, the other 20%, and you don't need to do an election for that. And the split can be changed year after year. It doesn't have to stay the same each year. And then just moving on to some of the CGT benefits on disposal. So because it is a trade, the gain may qualify for business asset disposal relief, meaning the gain is taxed at 10% rather than 28%. Obviously, there's a limit to those disposals, and the limit is now 1 million. It's previously 10 million. Another CGT benefit, they can also qualify for rollover relief. So any gain on an FHL can be rolled over into the purchase of another qualifying asset. That's a good relief. And then finally, one last CGT relief, the availability to claim gift relief. So any gain can be held over, no immediate CGT charge to pay, and the donee inherits the property at the base cost. Obviously with inheritance tax, there's some benefits there, and John is going to provide some details later. Just looking now at 3.5, we've got some of the changes that are happening from 6th of April 2025. So really we're aligning furnished holiday lets with long-term lets. So, but all of the benefits that I've discussed, they are going to be lost, and individuals are going to be taxed on income less expenses with a tax reducer at 20%. So some of the options, some considerations, things to think about. Obviously, we've got time to plan. This is happening in April 2025. We've got roughly 12 months to think about what, if we've got clients, what should they be doing? What should they be thinking about? So one option, they could sell the property, may qualify for business asset disposal relief. If they can get that done by the 6th of April 2025, they'll have a gain at 10%. And obviously, if business asset disposal relief doesn't apply, they would be subject to CGT at the rate of the new rate, which Charlotte's going to talk about shortly, at 24% from disposals from April 2024. And obviously, you need to remember as well that the CGT annual exempt amount, that is now at £3,000 from April 2024. Another option, something to think about, review the borrowing. If you've got higher rate taxpayers, additional rate taxpayers, they're obviously going to lose out on that mortgage interest. Can they look at the borrowing, mortgage paid off? They would really need to do take advice as to what would be the best thing to do. And then lastly, we could look at, again, going back to if the property is owned jointly between spouses, whether a declaration of trust can be made so that we can split that income unequally rather than having a 50-50 split, because it will be treated on a 50-50 basis from April 2025. So if declaration of trust is made, remember a Form 17 must be submitted to HMRC within 60 days. If not, it's not recognised by HMRC and you'll have to start the process again. So I'm going to pass back to John for some more details on FHLs and inheritance tax.
Thank you very much, Nicola. That's great. And I will, before I come to talk about IHT, let's just get a CGT perspective here. So one of our relatively newer colleagues, it's good to have Charlotte join us in our Manchester team. So Charlotte Pritchard is going to talk about CGT now. Over to you, Charlotte. Thank you.
Thanks, John. So I'm Charlotte Pritchard. I'm in the Lifestyle and Estate Planning team in Manchester. And so I just wanted to give some detail around the capital gains tax changes on residential property. The higher rate has been cut for residential property. Obviously, this wouldn't apply to clients disposing of main residences because the main residence relief would apply there. But for example, on furnished holiday lettings or other investment properties. So from the 6th of April 2024, the rate that we're used to seeing being 28% is going down to 24%. So the normal higher rate of CGT, 20%, the residential property surcharge was 8%, and that's coming down to 4%, so a new 24% rate. The lower rate remains at 18%, and any gains within an individual's basic rate band. So the lower rate being 10%, CGT, and then with the 8% surcharge, with it being residential property. But it should be noted that also changing from the 6th of April 2024 is the annual exempt amount for capital gains tax. So we've already seen this cut once, and it's going to be cut again from the current £6,000 allowance to £3,000. So we are going to see an extra CGT being paid by our clients on the first £3,000 worth of gains, which equates to £720, that being the £3,000 loss relief at a rate of 24%. And on slide 4.2, I'll just mention the furnished holiday lettings and the CGT change and why it's happening. So a few reasons to bring it in line with the furnished holiday letting treatment under the IHT regime, so there's some consistency. To eliminate the tax advantage for landlords letting furnished holiday lettings on short-term leases, and to disincentivise second homes in areas of natural beauty or coastal towns with the government are finding and responding to people saying that people can't get on the property ladder in their own towns because they're too beautiful and attract too many tourists and are driving out day-to-day business and economy. So this is to disincentivise that second home buying, and will hopefully release properties to the local community to either rent or to buy. So my next slide is 4.3, which is really the theme of today, looking at planning and what we can do. for our clients in response to these changes that are coming in. So we can be talking to our clients about no gain, no loss transactions between spouses. We can be discussing whether they should delay or expedite their transactions, given that we've got the reduction in the annual exempt amount versus the reduced rate of CGT. Though I appreciate that for many of your clients, that £720 is going to be irrelevant over the size of the transaction itself. I'm discussing with our clients what they should do about their furnished holiday lettings. So their options are that they could move it on to being a long-term let. They could sell those furnished holiday lettings and pay capital gains tax on any gains at a reduced rate if they're a high rate taxpayer, or they can just stay as they are, accept and put up with the situation and continue having furnished holiday lettings, but without the tax breaks that they previously had.
Thank you, Charlotte. Be back in a moment for another little item on IHT. But getting into IHT now, can I cover the first of my points, which is just to pick up the BPR issues for furnished holiday lets. This is quite a controversial area because whereas we've had a kind of quasi trading status for income and gains on furnished holiday lets, on slide 5.1, you'll see that it talks about the BPR position and the fact that the revenue consider it's quite straightforward. You don't get business property relief on FHLs because they say, and they've set it all out, and I've set out some of the reasoning in the inheritance tax manual on this slide. This is for you to read at your leisure, but it's always been slightly controversial, this, because actually what we're concerned with for business property relief, never forget the principle, the second line of my slide, how much is the business wholly or mainly an investment business? That is always the question. And if you are mainly an investment business, for example, you are having a long lease where you just simply collect in rents, that is clearly an investment. If you are clearly a trading business, for example, you are running a hotel and doing lots and lots of kind of hotel type things, you know, with people coming every night to stay in your hotel, that is at the other end of the spectrum. So in the middle, there is the grey area, and this is always the difficulty. How many services are being provided as part of the furnished holiday lettings? And I've set out the revenues arguments here, and I've said here that there is a case of about 10 years ago, Pawson, which was a bad case, should never have been brought because it set out a bad principle. And the revenue try and rely upon that all the time. If we go on to the second slide here, you'll then see the contrast, which is a different way of looking at it in the Graham case a few years ago, where one of my colleagues was involved in advising the clients. And in that case, they did get business property relief on a furnished holiday letting. I've said in my, sort of the second bullet point, it's all about facts. And in this case, there were lots of extra services. They had to over 4,000 hours per annum in doing the work in running the place because they kept very good records. And over half of that, more than half, was not about maintaining the building, was actually about providing the extra services. And if you're going to get BPR, you've got to show very good records as to why it should apply. But I've just set out a few comments here that might help you if you're trying to show in a particular case that this does get BPR. And as part of your planning, if you're thinking about a change which involves a gift element, then you need to think about the IHT element of that. Okay, going on to 5.3, a couple of other things that have changed on the IHT front. The first is that there was a consultation last year on environmental land management schemes. If you like your acronyms, there's another one here, ELMS, ELMS. Farmers are getting used to that now. It's the way that we reward people for keeping land or enabling land to be, kept for the sake of the environment. And this is the extension of APR for schemes which are, I've set out some of the details on here, managed as part of an environmental land management scheme. It will apply, and it's my last bold bullet point on this slide, it will apply to those schemes which are in place at budget day, as well as any new ones that take effect. But it isn't going to actually be a relief until 6th of April next year. For some reason, the legislation needs to be brought in and so on. There's still some work to be done on ecosystem service markets, and so they've set up a working group to look at that and try and provide clarity. I love it when the revenue say we want clarity on tax treatment. It's like, help us out, we can't do this on our own, we need others to help us. But we love to, we professionals love to help to actually contribute to make the law better. So that's one of the things that we will help to do in this case. So going on to 5.4, the final slide for me here is just the geographical scope of, just say farm business tenancies. Let's mention that first. There was a question raised about whether we would have to have farm business tenancies of 8 years or more, because what was happening was a lot of people are taking out short FBTs, getting 100% APR on their land, and that short FBT then restricts what can be done environmental land management wise. So, you know, it was don't do anything with this, don't do any water schemes, don't do any wetlands, you know, et cetera, et cetera. And so while the ROC review had suggested that it should be a limit of, it should need to be at least 8 years, that's been rejected by the government, so there's no change. So if you heard about that possible change, it's not happening. But the geographical scope is happening. That's from 6th of April in about 2 weeks' time. We are going over to APR and woodlands being restricted to property in the UK as planned, the details on the slide. So there was one other big change in the budget, and I'm going to come back to Charlotte now for that, which is the change as to how we can pay IHT. So Charlotte, over to you for the easing of the payment rules.
Thank you, John. So another part of my role isn't just the wills and estate planning side, it's the administration of estates as well. And this might be a problem that you've heard of or encountered yourselves. And it relates to applying for a grant on credit. So from the 1st of April 2024, the process has been eased and there will no longer be the need to have sought commercial loans. The intention is for the process of applying for a grant to be less cumbersome and more compassionate for the PRs, although we know unlikely to speed things up given the delays that we have at the probate registry. And on 6.2, I explain here that the process has, as I've mentioned, already been simplified. So there's no need, as there were previously, to demonstrate the attempts to secure a commercial loan. The hope is that it's going to streamline the process and lift some of the burdens on the administrative side for the PRs, administrative side for the court, and also the emotional burden on PRs. Previously, PRs, the personal representatives of the estate, be that executors or administrators, were asked to look to their own funds if there were no funds in the estate to pay the inheritance tax and the cost of probate. So the hope is that this will reduce that burden. We're hoping that it will also lead to a quicker resolution of the estate's inheritance tax obligations and lead to a more efficient probate process. Less financial pressure on the PRs, as I've mentioned, as they no longer have to use their own assets to secure loans. And that's all that I have to say about that. So back over to Nikki.
Thank you. OK, so that's great. If you've got any questions, do please put them in the Q&A box. That would be great. We've got a couple of questions so far. But Nikki, just can you pick up the child benefit point, which is a nice little acronym for your HICBC?
Thank you, John. Yes, so I'm just going to really briefly talk about these reforms. So these come they're very welcome. So many organisations, they've been lobbying for a change to this charge, and they finally acknowledged the unfairness in this existing policy. So just for a really quick background, it was implemented in 2013. It was originally intended to target higher rate taxpayers. It was overcomplicated. There was little awareness of the charge, so lots of people were penalised. The charge applies where one parent's income exceeds £50,000. So you could have two parents earning £49,000, no charge applies. So it's quite unfair. With inflation, that's increased the number of taxpayers subject to the charge. As a result, those earning over £50,000, they suffer a really high marginal rate of up to 64%. As I put on the slides there, we've got the rates of child benefit currently. So the draft spring budget has actually included the changes to the charge from 6th of April 2024. So firstly, the threshold is going to be increased from £50,000 to £60,000. So anyone earning less than £60,000 won't have that charge. It's estimated to take about 170,000 families out of paying the charge. And in addition to the increase of the allowance, the rate at which the charge applies will also be halved, meaning that the child benefit will not be withdrawn in full until an individual earns more than £80,000 a year. So when somebody does suffer the charge, it's called back a lot more slowly. So what can be done? So it's just really reviewing if you're going to have if you're going to be entitled, make sure you claim. If you've got an individual earning between £60,000 and £80,000, they may want to consider making additional pension contributions, making gift aid donations to preserve their entitlement. By doing this, it will adjust their net income and mean that they can claim more of the child benefit. And also consider if the tax return needs to be completed. Quite often, if you're paying the charge, you would normally have to complete the tax return, so you may have that burden. There is a future proposal consultation going on shortly to assess a household charge from 6th of April 2026. So that's in consultation. We'll see what that means. I don't know how the tax system will be ready to deal with this, but obviously any change would need to be simplified, but we're not really sure how this will be achieved right at the moment. So back to you, John.
Thank you very much, Nikki. And now we can come to a couple of questions. And first of all, we've got a very interesting question here from somebody saying, if a non-domiciled individual is planning to move to the UK in January 2025, will they benefit from the full 4 years under the foreign income and gains rule regime? Jess, do you want to take that one?
Yeah, thanks. Yeah, good question. So assuming the individual's been non-resident for 10 years, so this is the first time moving sort of to the UK. If they come in January 2025, they either need to remain non-UK resident, from January to April 2025, or that they either qualify as non-resident or they're UK resident. Split year doesn't apply. Treaty residence doesn't apply. So ideally, they try to remain non-UK tax resident until April 2025. Then they'll get the full 4 years under the new FIG regime. If they can't remain non-UK tax resident, then they would have only 3 full tax years of the regime. So that arriving sort of January 2025, you've got that tax year. 24-25 would be 1 year of UK residence, and then they only benefit for three years of the FIG regime.
Thank you. And then a second question, which is probably best for you, Jess, actually, although quicker. But if any individual is already UK deemed domiciled, so they're deemed domiciled already, and therefore not claiming the remittance basis, is there anything they need to be thinking about before 6th April 25?
So they're UK deemed domiciled and not claiming the remittance basis. So they'll probably need to be thinking about whether they've set up any trusts prior to the 6th of April 2025. And if they have, what does that mean post April 2025? So that sort of goes back to looking at what is the income and income tax and capital gains tax position of the trust if they have set one up. Otherwise, they might be if they're thinking perhaps of leaving, they might want to just consider that there might be a 10-year tail. So any planning that happens within those 10 years, they need to be careful with for HT purposes. But again, this is all sort of subject to consultation, so we don't quite know exactly what's coming just yet.
Thank you very much. And another question: under the new rules, can a non-domiciled settle a discretionary excluded property trust for their UK domiciled resident spouse to ensure the income and gains are only taxed overseas? Jess, could you also take that one?
So a non-dom settling an excluded property trust for their UK domiciled res spouse. So the non-dom, so the non-dom is if the non-dom is UK resident, that's going to be an issue. For the UK resident spouse, you need to be looking at how they're going to benefit from the trust itself. So if they're only going to be taxed to ensure income and capital gains are only taxed overseas, well, the UK resident spouse, they'll be matching to any benefits that they receive. So it's something to look at, I think, in a bit more detail.
There is so much in this, and
so
obviously
it's not quite straightforward.
No, absolutely, and indeed there is. We are awaiting the detail, of course. So I hope that's given you a bit of an answer there, those of you who asked those questions. If you have any more questions, do please let us know, and we'll be pleased to come back to you. Here are our contact details of all four of us, and we'd all be pleased to follow up anything afterwards. I hope you found that helpful. I hope that was useful. Please do fill in our feedback form with any comment. We've rushed through quite a lot of detail in that time, but hopefully it's given you something to chew on with your clients, something to flag up for people who may need to be getting some more advice. So with that, can I just say thank you very much for being with us. To those of you who are on the call, and those of you, I know a lot of you will also listen to the recording afterwards. Thank you for your time. Just two slides just to finish off with. One is about generally things we can do, which I hope may be of interest, and finally a reference to the book which I edited for the Law Society wrote with 14 of my colleagues. It looks, if we are going to have a new non-dom provisions, as though we're going to need to update this book. So a second edition may well come out next year, but not before then. So in the meantime, a lot of the provisions still stand good, but there we are. Thank you, everybody, and please give us your feedback. Thank you very much, and all the very best with all the changes. Thank you.